Hello and welcome to our Modern Money Journey. Just a brief reminder that I am not a licensed professional. This is not investment advice. This is for entertainment purposes only. Hey everyone, and welcome back for Adventure 5, where we're going to talk about bonds.
My name is Bond.
Bond.
Not those kind of bonds. We're going to talk about the bond market, also known as the debt market. We're going to just cover this market briefly because we're not going to spend too much time investing in it. However, the bond market or certain attributes of it are commonly looked at as indicators as to the overall health of the U.S. economy or global economy. So as we've mentioned before, the bond market is also known as the debt market. And as you may remember from Adventure 2, the equities market, also known as the stock market, combined with the bond market, is known as the securities market, which are regulated by the SEC. Now, the bond market is also part of the credit market. The other aspect of the credit market is just bank loans that are given out to people and companies by banks. So I'm more just mentioning this so that you guys are aware of the terminology. So just remember that securities means bonds and stocks, and the credit market means loans and bonds. Just terminology to know. So what is a bond, and why is the bond market considered the debt market? Well, when you are buying a bond either directly from a government or from a corporation, you are loaning money to that entity. So you are in essence providing them a loan. Once that bond is purchased from a government or corporate entity, it can then be traded on the bond markets, where prices can be bid up or down depending on the state of the market or the underlying entity. So when you are purchasing a bond on the bond market, you are in essence buying an old loan. I'm sure a bunch of you are thinking, yep, Joe, I know all about bonds. My grandma used to buy me $25 ones when I was a little kid. They're amazing. Those are savings bonds. They are direct contracts between you and the government when you purchase them, and they cannot be traded on open markets. So when we're talking about the bond market, we are not including government savings bonds. So let's get into the meat of the attributes of a bond. Well, first off, you have to buy one. So there's its purchase price. Its purchase price is its first attribute. That's simply the amount of money that you're going to pay for the bond. The second attribute is its term or maturity date. Since a bond is a loan, it is set to be repaid after a certain amount of time. That length of time is known as its term, and the date that it matures on is known as its maturity date. As a side note, government issued bonds sometimes go by different names depending on that term or the length to maturity date. Short-term bonds are often called bills with a term of usually less than a year, where medium-term bonds with terms of like 2 to 10 years are usually known as notes, and then long-term bonds are just referred to as bonds. But we will just generically call all of these bonds. Its third attribute is its face value, also known as its par value. So its face value is the amount of money that will be returned to you upon the maturity date. The amount you purchase the bond for can sometimes be above or below the face value of the bond, depending on a whole host of factors, including how much of the term is left, and as well as how is the underlying entity performing. The fourth attribute of a bond that we'd like to cover is the coupon payment, or the interest paid. So when you own a bond, you typically receive a payment twice a year or every 6 months that is determined when the original bond is sold and is some percentage of the face value or par value. So the amount that is paid is known as the coupon, and the percentage that is paid can be calculated by dividing the set coupon payments over a year divided by the price paid for the bond, which is the fifth attribute of a bond. Coupon rate or yield rate, as you can see, if the price of a bond goes up when you sell it, then the rate goes down even though the coupon payment stays the exact same. This is referred to as yields changing inversely proportional to prices. This simply means if the price goes up, the yield goes down, and if the price goes down, the yield goes up. Prices of bonds can be affected by a whole host of different factors, micro and macro, including, how is the underlying entity performing and what is the current bond's rating. So bonds are rated by rating agencies. Some examples are Moody's and Standard & Poor's. The highest rating that a bond can receive is known as AAA, which is also known as prime. And the lowest is typically referred to as single D, and most bonds under BBB are referred to as junk bonds. They are referred to as junk bonds because the underlying entity, the corporation or government that issued them, is likely to default on that bond. What does this mean? Simply means that they're likely not to pay back the loan value to them. So that they're likely not to pay back that face value or par value of the bond. So we have actually covered the basics of the bond and bond market. It's essentially a loan that an investor gives to a government or corporation for a certain amount of time, and they receive small payments twice a year over that amount of time, and then at the expiration of the bond, on the maturity date, they receive their loan amount back. It's that simple. At the beginning of the adventure, I said that there were several aspects of the bond market that investors look at to try and gauge the health of the economy. Those would be the yield curve and the yield spread curve. So let's talk about the yield curve. So the yield curve is simply a curve of all the yields of all the bonds. How about I draw you a picture and we go over an example of the yield curve. So this is an example of the yield curve. As you can see, on the x-axis, we simply have time or the maturity dates of various bonds, clear out to 30 years, and then we have the percent yield on them. So that's the percent interest earned by the coupon payments. And as you can see, as you go further out in time, the yield goes up, but it starts to flatten out. This is what a typical yield curve should look like in a healthy economy. As you go further out in time, you are paid a higher interest rate to loan your money to a corporation or the government. When it's perceived by investors that there'll be problems in the economy, they often buy many of these longer term bonds to guarantee a safe return on investment of a few percent over that long time frame, because they believe that there's going to be a downturn, that things aren't going to be healthy in the economy soon. So by buying these longer term bonds, it increases the price, and we've learned that increasing the price lowers the yield, which would shift these points down, and we would have what's known as a yield curve inversion, where these shorter term rates are higher than these longer term rates. So basically this part of the curve gets pushed down lower, where this part still can raise or stay the same. So if we see this curve get flattened or pushed down and inverted, that's typically a sign that investors in the bond market believe that an economic recession is on the way. Another good way to look at this is what's known as a yield spread curve. Spread simply means the difference between two different yields. So we can pick the 10-year yield and we can pick the 2-year yield and look at the difference between those two. So if the spread between the yield of those two goes negative, that means that the 10-year is now below where the 2-year is. That means that you can get a higher yield in the 2-year than the 10-year, but that means that more investors are flocking to the 10-year yield because they believe that there's problems in the economy. So a yield spread curve is the yield paid on a long-term bond minus the yield paid on a short-term bond. So since the yields are typically higher on long-term bonds, that higher number minus that lower number will give you a positive number. However, when they invert, that can become negative. Here's an example of the 10-year minus the 2-year bonds, which is a very common indicator of when an economic recession is going to occur. You can look here on the graph and see every time that the spread drops below 0, there's a gray bar shortly after. These gray bars indicate economic recessions within the United States. So that's all we're going to cover in regards to bonds. Just wanted to give you guys a brief overview of the market and some terminology, because we will come back to some of these concepts in later adventures when we're looking at states of the market and building our portfolio, since the bond market is so well known for being an indicator of how the economy is doing. Alright, all you bulls and bears, I'll see you next time on our upcoming adventures.